Good morning, everybody. Happy Thursday. It's April 18th, 2024. Great to be with all of you today. My name is Bob Lang, and it's time for our daily bites. Come at you every Monday and Thursday, roughly around 8:30, 8:45. Talking a little bit about the markets, the economy, the Fed, inflation, what the markets have done, what they may do going forward. Ring fence all the data and information, trying to figure out how to proceed going down the road here. So it's been a pretty down week for the markets. The bulls have had their backs up against the wall, especially recently. We're going to see some charts in a little bit, and I'm going to now today's broadcast is only on YouTube. I don't have the Twitter hooked up right now, or no LinkedIn, but so you should be able to see everything off of YouTube, and that'll all be sent out later on today. So you see S&P futures are up about 4 points right now. They're off their highs, and you can see that the Dow Industrial is up about 45 points. It was up a little bit yesterday, thanks to some strength in some of the bigger industrial names, but by and large, the rest of the market has just been awful, and we can thank the Russell 2000 for some of that. We'll see a chart of that in just a moment as well. And something you all have to remember is that market corrections happen, right? Markets don't go straight up every single day forever, but when you get lulled into the complacency of markets constantly going up, and when they do go down, they tend to recover those losses rather quickly, over and over and over again. We get conditioned to believing that markets A, don't go down, or B, if they do go down, that we've got to buy that dip every single time, right? Well, I'm here to tell you that if you take a look at conditions the way they are in the markets, using tools such as the relative strength, or the MACD, or money flows, some of the tools that I use, moving averages. I'm here to tell you that some of these things are going to signal red flags at moments in time, and right now we can see that happening. Red flags are being posted in very many places around the markets. And I'm going to show you the new highs, new lows, something that we look at from time to time, and see the differential in that from what we had earlier in the year, and then what we also had late last year before the markets actually bottomed here. So, so again, we have the markets up a little bit this morning, trying to recover a little bit of ground. I had been talking more recently about some good support levels around the 50-45 to 50-55 area on the S&P 500. Call it 50-50. We broke that significantly yesterday. It closed right at 50-51 on Tuesday, and we were trading above there, and it just fell apart towards the end of the day yesterday. It closed near the lows of the session on Wednesday. The Russell 2000 actually did finish on its dead lows and actually had a huge outside day yesterday. Let's take a look at that chart right now on the Russell 2000. And something I've been talking about as well too, the Russell 2000 is pretty much the driver of breadth, right? Because if you look at breadth and say that every stock in the index S&P 500 when talking about breadth, gets one vote, it's not a cap weighted index that we measure for breadth. It's just that it's just how many stocks are up versus how many are down, right? Every stock gets an equal weight. The Russell 2000 has a lion's share of the names that are measured against that 2,000 stocks, which the S&P 500 is 500, the NASDAQ 100, obviously 100, and the Dow is 30. But take a look at this chart here of the Russell 2000. This index has corrected quite significantly from about 212 all the way down to 193. Do the math. That's about 20 points. That's about 10%. So the Russell 2000 has fallen about 10% from the recent highs. That's not even the all-time highs. All-time highs are in the 220s. So a 10% drop here, nobody's really even been talking about that. I guess that what we've learned over years is that a 10% drop is your textbook definition of a correction. Nobody's even said that the Russell 2000 is in correction territory. We may find out next week when the financial media finally comes around to it and says, "Oh wow, we missed this one." But I'm telling you right now, here April 18th, Russell 2000 in correction territory. Where could it drop down to? I've been talking about the high 180s for a while now. Why is it high 180s? Because once it dropped below that 50-day moving average, which is right here, the blue line, and it couldn't get through there, you had to be looking at lower targets. We knifed through that 100-day moving average on Tuesday, and now we have the 200-day moving average. Comes in at where? 188. That's why I looked at that area. We do have some areas of support down even below that, about 179 to 181. So if that doesn't hold, then we could be heading down towards those levels. However, if you take a look at the RSI, we're right near oversold levels on the Russell 2000. So if we get a little bit more downside here, and we touch this 30% level, which is oversold, and we hit that 200-day moving average at the same time, that's where you're probably going to get a bounce. Okay, is it a buyable bounce? I mean, I'm not into buying tops or buying bottoms or selling at tops. That's not my game. I'm a momentum player. So I want to see how the Russell 2000 does off of that little drop, and then move on up. So or down wherever it may lead after that. Here's the a chart that we look at quite frequently. This is the NASDAQ new highs versus new lows, right? And this is a real good look at the breadth of the markets, right? And why is it important? It's important because if the market is going to continue to go higher, you got to have more new highs than new lows, right? It makes sense, doesn't it? You got to have stocks making new highs, dominating over new lows. And we had that for a good part of 2024 and the end of 2023, right? You can see very nice large prints on the NASDAQ high-low list. Also on the NYHL, $NYHL, which is the New York Stock Exchange, high-low list. But what are we seeing recently here? We're seeing lots of prints below zero, right? Alert time, everybody. This is something you got to pay attention to, right? When you get a change in character in the market, you have to have an unbiased view and realize that, hey, look, you know what? I have to change what I'm doing to what the market is going to do, rather than me trying to force the market to do what I want it to do. Okay, so it's important to recognize when the conditions change, right? You have to change your mind. What did John Maynard Keynes say 100 years ago? When the markets change, I change my mind, sir. What do you do? Right? He was absolutely correct, and that phrase stands the test of time. There's no disputing that, because you could see, taking a look back here towards the middle end of 2023, we had a whole cluster of these negative readings on the Nasdaq, and forced the Nasdaq down quite a bit. We were down quite sharply towards the end of summer and into the fall of 2023. It wasn't until about November, December where we bounced back, but still the damage was done right over here. And you can certainly extrapolate that this could be the start of something much bigger than we have right here. Maybe something similar to this right here. So this is going to put a lot of undue pressure on the markets. Now, talk about seasonality for a moment, right? We're at the end of April, towards the end of April here. We have 9 trading days in April left, and then we start the beginning of May. And what is May known for? What does it characterize that? Sell in May and go away, right? Seasonal. Why do people say that? It's because seasonal patterns, seasonal trends, tend to not favor the bulls or the market during this next 6-month period between May and the end of October. Right, so you have some of your worst performing months of the calendar year happen to fall between May and October of a calendar year. So that's something also that the bulls are going to be fighting. We have an earnings season right now going on, and it's somewhat mixed, right? Some of the earnings have been pretty good, but you understand that the market already anticipated the strong earnings that are coming in now. last year, right? We know how the markets work. Markets are a discounting mechanism. They forecast what earnings are going to look like into the future, right? That's all. That's all the stock market is, anyway, right? It's an indicator. Stock market is not the economy. It is an indicator that tells you how good or healthy the economy actually is, right? So one thing I've noticed about so far in this early part of first quarter earnings season is that we haven't seen a whole lot of buybacks being announced, right? And why is that? It's because I think a lot of these companies either haven't finished their buybacks, A, B, their stock prices are too high to be buying it, or C, they have other uses for those resources, for that money, instead of buying back their own shares, right? Or D, they're just preferring to pay dividends. Some of these companies prefer to pay dividends rather than doing buybacks. So any of those reasons are valid, but we often see stocks get a nice pop, a little bit of juice in their price when a company announces a large buyback, because it reduces the amount of shares and eventually increases the earnings per share for that stock. So if these companies, if we're watching, I would suggest all of you keep an eye on these companies over the next 2.5, 3 weeks, right? We've got a lot of big names reporting soon. We've got IBM next week, Intel, Amazon is going to be reporting in a couple weeks, Apple, of course, Meta, Google, a whole bunch of names are going to be reporting, Disney, into the middle of May. So keep an eye out and listen to some of these calls and read some of these reports and see if this is holding true, that some of these companies are not announcing buybacks or increasing their buybacks or whatever, because it's an important component to the markets and for earnings. As far as charts are concerned, let's take a look at the SP 500. We can see how much it's rolled over here, and it's approaching oversold reading on the RSI. Not quite there yet. Where do I think this is going to go? I'm thinking of 4,900. And I'm looking at at the 100-day moving average. That's about 49.20 right now, still moving upwards. And you can see that the 50-day moving average, which it crossed on Tuesday, closed below it on Monday, Monday, and then Tuesday, Wednesday, lower highs, lower lows. It's starting to flatten out. And it flattens out, and then this 20-day moving average, the dotted line, which is at 51.83, crosses under that. That's going to be some severe resistance. So we're going to see the markets are confirmed into a downtrend. I think it's already confirmed it now, but I'm a little bit early. I've lightened up a lot of positions that I've had on for the past couple of months, taking some of that money off the table, and I'm just going to step back and wait, because I know that in this part of the process, it's the hardest trading environment that you're going to be in. It's very, very tough. It's challenging. And we have to change our mindset. Again, as I talked about earlier, we have to change our mindset. What part of the mindset do we have to change? Our timing, right? If you have, you can't sit there and buy something that went down and then all of a sudden goes up, and then sit there for days or weeks and say, okay, well, I'm just going to, I caught the bottom and everything's going to move right back up again. Look what happened to the markets yesterday. Let me bring that up for you. I want to show you just one example of what this looks like. So take a look over here to the left-hand side of this is the ES futures chart. And you can see yesterday the action was very, very poor most of the day, right? We started rallying back the midday, and then towards the afternoon made a nice little cup and handle pattern, and then we had this big, huge bar up, right? We went from 50.76 all the way up to 50.95, 20 handle move in one bar, and then it was destroyed in 2 bars after that. 5 minutes here, 10 minutes here, it was completely destroyed, and it was lost. All that gain, all those 20 handles were gone in 2 bars. We went down 22 handles, and then we ended up closing lower after that. So what are we doing here? There's no follow through. It's trapping people in there who think that the markets are going to break out, and the market will continue to deliver punishment like this until the conditions change. And I've laid out already for you some of the reasons why those conditions may not change for a while. We are in an election year, of course, and that's going to matter at some point in time. Volatility is on the rise as well too. So let's take a look at that for a minute. The VIX here, and you can see it's made a sharp move up. One thing I want you to notice here, let's open this up a little bit so you guys can see it a little better. Do you see this dotted line over here? This is the 20-day moving average, okay? See this black line right over here, up here on the top? I'm tracing with my cursor. That's the 200-day moving average. So we've had the 20-day moving average crossing above the 200-day moving average for the first time in quite some time, right? It's been a while. That is bearish for the markets. Bearish for the markets, okay? So keep that in mind. So when that trend of VIX starts turning upwards, and then we had it confirmed by this crossover move, which happened yesterday, expect some big swings, right? A couple of days ago, we had a big swing. We had a 100-point swing in the SP 500, and it just went, basically people yawned at it, right? We hadn't had a 100-point move in the market since maybe, I think it was back here in February. We had one day like that, which we spiked up and came right back down. And so last week, we had a big old spike up in the VIX and closed towards the middle of the range on Friday, and people thought, well, Monday, okay, well, we're going to come back down. Well, we ended up closing at the highs of the session, and we're still above those closes that closed on Friday, which was about 1730. So VIX at 18% is extended. It's not good for if you're on the bullish side of the markets. Now, let's remember something about VIX before I wrap things up here. A high VIX tells you what? It just means that the range is expanding, right? It just means that we're getting big moves. I just told you that we had a 100-handle move in the SP 500 just a few days ago, right? We've had a 50% rise in volatility in less than a month. Where is that at? We were at 12 at the end of March. Now we're at 18, 19. That's a 50% move up in volatility. So it means volatility has increased that much exponentially, and that you're going to get these large moves in the markets up and down. You might remember those sleepy days back in December, or maybe even a later part of January, where the SP 500 was moving 10, 11 handles in one whole day. 10, 11 handles. Now multiply that times 10, and we had a 100-handle move, and it's going to make people nervous, right? Again, volatility doesn't necessarily mean markets are going to be negative. What it means is that the mentality of the people who are trading this market are going to be fearful and scared and worried and start taking money off the tables. That's why we often see markets declining when volatility goes up. They're doing the wrong thing. All volatility is doing is expanding the range. No, it's not expanding. It's explaining what the markets are doing, and that means that range expansion, right? So we're going to have big, huge moves. It just makes people very uneasy to be invested or trading with those big moves that are happening. So hopefully that makes sense. All right, I'm going to wrap it up, everybody. I wish you guys all a great trading day here. One more look at the markets here. It looks like the S&P futures rallied a little bit more from when we first started. We have some big earnings coming out tonight with Intuitive Surgical, Netflix after the close, and PPG, industrial name. Anybody know what PPG stands for? I'll tell you. It stands for Pittsburgh Plate and Glass. And then tomorrow we have another big day of earnings with American Express. Before the market opens, Procter & Gamble and Schlumberger, now called SLB, and a few other regional banks. So should be a busy day today and tomorrow. Couple Fed speakers today, a couple more tomorrow as well too. And I think starting Monday, the quiet period starts because the Fed meeting starts April 30th, so a week from next Tuesday. When the Fed meeting gets underway, so and they'll announce a policy statement on May 1st. Which, by the way, Fed funds futures predicting 40 basis points of rate cuts into the end of the year. What is 40 basis points? That's less than 2 rate cuts. That's about 1.5 on average of 1.5 rate cuts into the end of 2024. So we have 6 meetings left into the end of the year, and the market is somewhat in line with the Fed right now, maybe not even that much. We have the PCE number coming out next week. We'll talk a little bit more about that next week. But yeah, so the market is now a little bit more in line with Fed's expectations, and we'll see how that goes over the next couple months. Obviously, pay attention to the data. That's what they're doing. Have a great day, everyone. I appreciate everyone spending a little time with me today, and I'll see you guys all on Monday. Let's see if the market's going to give it up. Thanks, everyone.